The US economy is vulnerable to a significant shift on Wall Street, as about 62% of Americans invest in stocks. Latest data shows that the wealth of American households surged to a record during the July to September quarter last year, reflecting US stock markets run to all-time highs. And in this next report, we decode the risk to the US economy from a crash in the stock market. Take a look.
Last year, in the September quarter, US household wealth rose to a fresh record as the stock market continued to rally. Household net worth climbed nearly $6.1 trillion from the prior quarter to $181.6 trillion. That is, according to a Federal Reserve report. The S&P 500 rallied through that quarter and reached a record. That fueled increased wealth among Americans who invest. Stock prices were driven higher by optimism about artificial intelligence. The prospects of lower interest rates and healthy corporate earnings, clearly, that trend has extended into the new year, with Wall Street stocks hitting fresh record highs repeatedly. On Monday, even small-cap stocks notched their longest winning streak over their larger peers in 7 years. While the stock surge has resulted in increased wealth for Americans, a Gallup survey showed stock ownership correlates strongly with higher household income, education levels, age, and marital status, with disparities across racial and ethnic groups. That has increased the wealth gap in the country. The wealthiest 1% of households own 50% of all US stocks, while the bottom 50% own only 1%. That shows extreme concentration of equity wealth. In America, about 62% households invest in stocks directly or indirectly. Comparatively, Indian retail investors account for just a fraction of the population. Indian individuals are increasing their participation, reaching record ownership levels. Still, the percentage is about 6% of the 1.5 billion population. For America, the bigger risk is to the economy. If the stock market sees a deep sell-off, the wealth wipe from a crash in stocks will be felt more broadly, and the income gap will widen more deeply. American stock ownership significantly contributes to GDP, with US equity market capitalization over 210% of GDP. The investment share of nominal GDP is a key economic metric, averaging around 24% historically, but varies significantly quarter to quarter. Finance, insurance, real estate, rental, and leasing sectors are major contributors to GDP, accounting for over 21% of value added. In essence, stock ownership has indirect but substantial effects on the economy through consumer confidence and investment. For this year, the relationship between American stock ownership and the national economy remains a central pillar of US financial stability. While the stock market itself is not a direct component of GDP, it acts as a critical driver of the consumer spending and investment that fuel economic growth. Business Bureau WION, World is One.